Navigating the Maze, a deep dive into proposed Social Security changes, Medicare pitfalls, and your benefits. In the ever-shifting landscape of American politics and personal finance, few topics command as much attention and anxiety as Social Security and Medicare. These programs form the bedrock of retirement security for tens of millions. Recently, discussion around a big beautiful bill in the Senate has brought a new proposal into the spotlight, sparking both hope and confusion. This proposal, coupled with the timeless complexities of the existing system, makes it more crucial than ever for current and future beneficiaries to understand not just the headlines, but the intricate details that directly affect their financial well-being. This detailed analysis, based on a recent in-depth discussion, will dissect the proposed tax changes, demystify the daunting process of handling overpayments, explore the unique challenges faced by Americans abroad, clarify the rules around survivor and spousal benefits, and examine the looming threat of budget cuts. This is not just a summary of rules, it is a guide to empowerment, helping you navigate the system, advocate for yourself, and make informed decisions in a world of complex legislation and bureaucratic hurdles. 1. The $6,000 question. Unpacking the proposed tax deduction. The centerpiece of the recent Senate proposal is a new $6,000 tax deduction. The language sounds promising, but as with all things tax-related, the devil is in the details. The most critical detail is the distinction between a tax deduction and a tax credit, a concept that fundamentally changes who benefits and by how much. Tax deduction versus tax credit. The crucial difference. Imagine your income is a big pie. A tax deduction shrinks the size of the pie before the government takes its slice. If you have a $6,000 deduction, you simply subtract that amount from your income, resulting in a smaller, taxable income. The actual dollar value of this benefit depends entirely on your marginal tax bracket. For someone in the 22% tax bracket, a $6,000 deduction reduces their tax bill by 320. 320. 6,000 by 0.22. For someone in the 12% bracket, the same deduction is only worth 720. 720. 6,000 by 0.12. A tax credit, on the other hand, is a golden ticket you use after the government calculates your tax bill. A $6,000 tax credit would reduce your tax liability by the full $6,000, dollar for dollar, regardless of your tax bracket. It is a direct reduction of the tax you owe. The Senate's proposal is a deduction, not a credit. This immediately tells us that its impact is not uniform. It provides more significant dollar savings to those in higher tax brackets. However, the proposal has another layer of targeting that makes its application even more specific. Who actually benefits? The tax on Social Security benefits. The summary correctly states that this deduction is primarily beneficial for the 40 to 50% of Social Security recipients who pay federal income tax on their benefits. To understand why, we must first understand how Social Security benefits are taxed in the first place. The taxability of your benefits is determined by your combined income, also called provisional income. The formula is combined income equals your adjusted gross income, AGI, plus non-taxable interest plus 50% of your Social Security benefits. The IRS then applies the following thresholds for tax year 2023, subject to change. Single filers. If your combined income is between $25,000 and $34,000, you may have to pay income tax on up to 50% of your benefits. If your combined income is more than $34,000, up to 85% of your benefits may be taxable. Married filing jointly. If your combined income is between $32,000 and $44,000, you may have to pay income tax on up to 50% of your benefits. If your combined income is more than $44,000, up to 85% of your benefits may be taxable. Here is where the proposed $6,000 deduction comes into play. It lowers your AGI, which in turn lowers your combined income. For someone whose income is just above one of these thresholds, the deduction could push them below it, potentially eliminating the tax on their Social Security benefits entirely. For others, it might reduce their taxable benefits from the 85% tier to the 50% tier, or simply reduce the amount taxable within a tier. Who is left out? Conversely, the deduction provides no value to several large groups. Lower income recipients. The majority of Social Security recipients, roughly 50–60%, have combined incomes below the $25,000, single, or $32,000, joint, threshold. They do not pay any federal income tax on their benefits. Since they have no tax liability on their benefits to begin with, a deduction aimed at reducing that tax is useless to them. Very high-income recipients. The proposal includes a phase-out, meaning the deduction's value diminishes and eventually disappears for those with incomes above $175,000. This is a common legislative tool designed to target tax relief to middle-income households and limit the bill's overall cost. A temporary reprieve. It is critical to note that the proposal is temporary, slated to last only from 2025 to 2028. This makes it a short-term planning tool, not a permanent structural change to the tax code. In essence, the proposed $6,000 deduction is a highly targeted, temporary measure designed to provide tax relief specifically to middle-income retirees who currently pay taxes on their Social Security benefits. It is not a broad-based benefit for all seniors. 2. The overpayment nightmare. How to fight back and reclaim control. Few things can induce panic like an official-looking letter from the Social Security Administration, SSA, stating you've been overpaid and now owe the government thousands of dollars. These overpayments can happen for many reasons: an error by the SSA, a recipient's failure to report work income, a change in marital status, or other complex eligibility issues. The initial instinct may be to despair, but the system provides a clear path for recourse. Step 1. The request for waiver, Form SSA 632. Your most powerful tool is the request for waiver of overpayment. A waiver is essentially a request for forgiveness. To be granted one, you must prove two things. The overpayment was not your fault. You must demonstrate that you did not knowingly cause the error. For example, if you reported your income correctly and the SSA made a calculation error, or if you were given incorrect information by an SSA employee, the fault is not yours. Documenting every interaction and keeping meticulous records is your best defense. Paying back the money would cause financial hardship. This is defined as being unable to meet your ordinary living expenses: food, shelter, utilities, medical care. The SSA will ask for a detailed accounting of your income and expenses to determine if repayment would defeat the purpose of the Social Security Act by leaving you destitute. Step 2. The personal conference. If your initial waiver request is denied, you have the right to appeal. A crucial part of this process is requesting a personal conference. This is an informal meeting, either in person or over the phone, with an SSA decision-maker who was not involved in the initial determination. This is your opportunity to tell your story in your own words, present your evidence, and have a human being listen to the context behind the numbers on the form. It is a vital step in ensuring due process and can often lead to a reversal of the initial denial. Step 3. The congressional escalation. When the bureaucracy of the SSA becomes a seemingly impenetrable wall, and phone calls and letters go unanswered, there is another powerful avenue: contacting your congressional representative's office. Every member of Congress has constituent services staff whose job is to help people in their district navigate federal agencies. When you contact them with a well-documented problem, they can file a congressional inquiry on your behalf. This inquiry lands on a specific desk at the SSA reserved for handling legislative correspondence. It often has the effect of cutting through red tape, elevating your case for a higher-level review, and compelling a prompt and thorough response from the agency. It is a free, effective, and underutilized tool for citizens facing a bureaucratic stalemate. 3. Global citizens. The complexities of disability and Medicare abroad. For the growing number of Americans living overseas, managing U.S. benefits can be a logistical and financial minefield. While retirement benefits are relatively portable, disability benefits and Medicare present unique and costly challenges. Disability benefits from afar. Receiving Social Security Disability Insurance, SSDI, while living abroad is possible but complicated. The SSA is required to conduct periodic, continuing disability reviews, CDRs, to verify that you still meet the medical criteria for disability. This often involves new medical examinations and extensive paperwork, which can be extraordinarily difficult to coordinate from another country, especially with potential language barriers and different medical systems. The Medicare Part B conundrum, a costly trap for expats. Medicare is the most significant challenge for expats. The core problem is that Medicare provides virtually no coverage for healthcare services received outside the United States. This leads many expats to a seemingly logical conclusion: why should I pay for something I can't use? So they consider dropping Medicare Part B, which covers doctor visits and outpatient services. This can be a catastrophic financial mistake due to the late enrollment penalty. If you disenroll from Part B and later decide to move back to the U.S. and need coverage, you will face a permanent penalty. For every full 12-month period that you were eligible for Part B but did not have it, your monthly premium will increase by 10% for the rest of your life. Consider an expat who drops Part B for 10 years. Upon returning to the U.S., their monthly premium will be 100% higher, 10 years x 10%, than the standard premium forever. The decision to keep or cancel Part B becomes a serious risk assessment. You must weigh the certainty of paying monthly premiums for a service you aren't using against the potential catastrophic risk of facing lifelong penalties if your circumstances change and you need to return to the U.S. for healthcare. For many, paying the premium is a form of return to the U.S. insurance. 4. The Family Web, demystifying survivor and divorced spouse benefits. Social Security is more than a retirement program for an individual worker. It's a family-based social insurance system. Two of its most important but often misunderstood provisions are benefits for survivors and divorced spouses. Survivor benefits. Timing is everything. When a Social Security recipient passes away, their surviving spouse may be eligible for survivor benefits. The amount and timing are highly dependent on several factors. The survivor's age. A surviving spouse can start collecting benefits as early as age 60 or 50 if disabled, but the benefit will be permanently reduced. To receive the full 100% survivor benefit, they must wait until their own full retirement age, FRA. The deceased's claiming age. The survivor's benefit is based on what the deceased spouse was receiving or was entitled to receive. If the deceased claimed their own benefits early, before their FRA, the base amount for the survivor benefit will be lower. Strategic claiming. A critical strategy exists for survivors who have also worked and are entitled to their own retirement benefit. Before reaching FRA, a rule called deemed filing forces you to effectively apply for all eligible benefits at once, and you receive the higher of the two. However, once you reach your FRA, you can choose to claim only the survivor benefit while allowing your own retirement benefit to continue growing by 8% per year until age 70. This can result in a significantly higher personal benefit later in life. Divorced spouse benefits. An entitlement you've earned. Many people are unaware that a divorced individual can claim benefits based on their ex-spouse work record. This has no negative impact on the ex-spouse or their current spouse. To qualify, you must meet 4 key criteria. The marriage lasted for at least 10 consecutive years. You are currently unmarried. You are at least 62 years old. Your own Social Security retirement benefit is less than the spousal benefit you would receive from your ex-spouse record, which is up to 50% of their full benefit amount. Crucially, your ex-spouse does not need to have filed for their own benefits yet. They only need to be eligible, i.e., at least 62. As long as you have been divorced for at least 2 years, you can claim independently. This is a vital financial lifeline for many individuals, particularly those who spent years out of the workforce as a homemaker. 5. Working while on Social Security. Understanding the earnings test. A common question is, can I work and still receive my Social Security check? The answer is yes, but with an important caveat if you have not yet reached your full retirement age, FRA, which is currently 66 to 67, depending on your birth year. This is known as the Retirement Earnings Test. 4 years before you reach FRA. There is an annual earnings limit. In 2024, it is $22,320. For every $2 you earn above this limit, the SSA will temporarily withhold $1 of your benefits. For the year you reach FRA, the limit is much higher. In 2024, it is $59,520. The withholding is also less severe. $1 is withheld for every $3 you earn above the limit, and it only applies to earnings in the months before your birthday. After you reach FRA, the earnings test disappears completely. You can earn any amount of money without any impact on your Social Security benefits. The most important thing to understand is that this is not a tax. The withheld benefits are not lost forever. Once you reach your FRA, the SSA recalculates your monthly benefit amount, giving you credit for the months in which benefits were withheld. This results in a slightly higher monthly check for the rest of your life, effectively paying you back over time. However, in the short term, it can feel like a significant penalty and requires careful planning. 6. The political elephant in the room: proposed cuts to Medicare and Medicaid. While the proposed $6,000 tax deduction is a giveaway, legislative packages often contain takeaways to balance the budget. The proposed bill reportedly includes significant cuts that could endanger the health and financial security of millions.